Okay, let's unpack this. You shared some really detailed analysis on Fair Isaac Corporation FICO.
That's right.
And this isn't just, any company. It's the creator of that credit score, that number that, well, it feels like it follows you everywhere.
It really does. It's woven right into how finance works today, maybe more than people realize.
Definitely. It's a critical piece of the whole system.
Absolutely fundamental.
So our mission here with this deep dive is to take all this great material you sent over, the analysis, the numbers, customer feedback, even that red team challenge, and pull out the key insights. We want to connect the dots, really get a handle on what's going on with FICO based only on this analysis.
Right. So we'll look at how the business actually works, what gives it that competitive edge, the moat, as they call it.
Yeah.
Then we'll get into management, the financials, that tricky price versus value question, and importantly, the risks that the analysis highlights.
Okay, sounds good. Let's jump in. Where do we start? The engine room, how FICO actually makes money.
Yeah, let's start there. The analysis points to a dual business model, two main parts.
Okay.
You've got the scores segment and the software segment. Scores is the big one, the crown jewel, as the analysis puts it. Recently, that's been like 54% to 60% of their revenue.
And that's the FICO score itself, the one everyone knows. They license that out.
Exactly. The biggest chunk of that is B2B, business to business.
So lenders paying them.
Right. Banks, mortgage lenders, auto finance companies, credit card issuers. They pay FICO a fee every time they pull your FICO score for an application.
So revenue depends on volume, how many scores are pulled, but also price. The analysis had a pretty striking example of that, didn't it?
It really did. Q1 fiscal 2025, B2B revenue jumped, get this, 30%.
Wow.
And the analysis breaks it down. A huge surge in mortgage volumes, like 110% increase.
Okay.
Plus FICO raised prices. That ability to hike prices, that's really key to understanding their power. We'll circle back to that.
Got it. And there's a smaller consumer piece too, myfico.com.
Yeah, B2C, smaller but stable revenue. People subscribe for score monitoring, that sort of thing. And partnerships. It helps keep the FICO brand strong with consumers directly.
Okay, so that's scores. High margin, the core brand. What about the other, 46%? The software segment.
Right, so this is more behind the scenes. It's their enterprise software. Think analytics, decision management tools for big institutions.
Like fraud prevention.
Exactly. Falcon Fraud Manager is a big one mentioned. Tools for risk management, onboarding customers, compliance, all that stuff banks need.
And the big strategic push there, according to the analysis, is moving clients to the cloud, the FICO platform.
That's the key strategy. They want to build this stickier ecosystem, get clients onto this central platform. It's less about one-off transactions, more about recurring revenue.
How do they measure success there?
Things like ARR, annual recurring revenue, and dollar-based net retention. Basically, are existing customers spending more each year?
And are they?
Yeah. The analysis highlighted platform ARR grew 31% in fiscal 24, and that dollar-based net retention was 123%.
123%. So existing clients spent 23% more.
Exactly. That suggests it's pretty sticky once clients are on board.
Okay, so you've got this incredibly profitable scores business, the analysis mentioned, and 89.2% operating margin in one quarter. That's huge.
Just phenomenal margins, and it's described as a cash machine, basically.
And that cash funds the R&D for the software platform.
Right, that transition.
And also aggressive share buybacks. The analysis called it a powerful internal flywheel.
That's the picture, yeah. Scores generates cash, cash funds software growth, and shareholder returns. It's a clear, rational model laid out in the analysis.
And the core idea, assessing lending risk, that seems pretty fundamental, pretty enduring.
It does. The analysis really emphasizes that. As long as people borrow and lend, you need some way to gauge risk. The FICO score is like a common language for that.
A common tongue, the analysis called it.
Exactly. Critical infrastructure. And that makes it pretty resilient, even when the economy goes up or down.
Okay, that leads right into the competitive fortress, the moat. What does the analysis say gives FICO its strength?
It calls it a classic wide economic moat, built on two main things: intangible assets and network effects.
Intangibles, like the brand itself.
Precisely. FICO is basically synonymous with credit score in the U.S., right? That's built over, 60 plus years? Plus, they have hundreds of patents on their algorithms, a long-standing reputation for being accurate, independent.
And decades of trust built up. And the network effect, that's where more users make it more valuable.
Correct. Lenders use it because other lenders use it. It's the standard. Investors buying mortgage bonds demand it. Regulators know it. You track your FICO score.
So everyone's kind of locked in.
It creates the self-reinforcing loop, yeah. The analysis says it's just inefficient and costly for anyone to try and deviate from that standard.
And the analysis had that great example of the moat in action, the pricing power.
Yeah, that mortgage score price hikes, going from roughly $3.50 to almost $5 per score for Fannie and Freddie.
That's over 40%.
Huge increase. And the CEO, quote in the analysis, basically acknowledges it was a big driver of profit and revenue.
Being able to do that without, everyone just leaving. That says a lot.
It's strong evidence of their position, yeah. Almost monopolistic, as the analysis suggests. Shows how embedded they are.
So this moat, is it getting wider? Shrinking? Staying the same? What's the analysis say about the trajectory?
The read from the analysis is stable, but facing its most significant challenge to date. So not collapsing, not necessarily widening right now, but definitely being tested.
What's the evidence for stability?
Well, things like their market share remaining incredibly high, like 90% plus in U.S. lending, continued adoption of their newer scores like 10T, global expansion, and that stickiness in software we talked about, that 123% net retention.
Okay, but the challenge, you said most significant. The analysis really flags the regulatory stuff, right?
This is the big one. The potential crack in the fortress, according to the material, specifically the FHFA mandate.
The Federal Housing Finance Agency.
Right. They're requiring Fannie Mae and Freddie Mac to use a competitor score, VantageScore 4.0, alongside FICO's 10T score for mortgages.
So breaking FICO's exclusive hold on that government-sponsored mortgage market.
Exactly. And the analysis notes this was partly a reaction to FICO's price hikes.
And the analysis argues this is different from past threats FICO faced.
That's a key point. It says past threats were mostly market-based, competitors trying to win on merit. This is the government mandating dual sourcing.
Forcing the industry's hand.
Right. It forces everyone, lenders, tech providers, to build the infrastructure to handle VantageScore, to get used to it. The analysis argues that directly chips away at that single standard network effect that was so powerful for FICO.
So the big question hanging over FICO, based on this analysis, is, does this break their dominance in mortgages or just weaken it?
That's the core uncertainty. Is the foundation cracked or is it really broken? The analysis leaves that open.
Let's shift gears a bit. Look behind the curtain. What does the analysis say about how FICO is viewed by its customers and its employees?
It's actually quite interesting. The customer view is really split. Depends who you ask.
How so?
Well, if you look at direct consumers, the ones using myfico.com, the analysis points to App Store reviews, things like that. Overwhelmingly positive.
Really? Like what kind of ratings?
Like 4.8 out of 5 stars from over 22,000 reviews. People praise the accuracy, only 1 point off from the bank score, that kind of thing. Clean interface, focuses on information, not just upselling. They seem to see it as trustworthy, valuable.
Okay, but what about, say, the average person who just encounters their FICO score? Maybe sees discussions online, Reddit perhaps?
Totally different picture painted in the analysis there. Much more frustration, confusion, sometimes outright distrust.
Why?
Perceived as opaque, Hard to understand why the score moves. Complaints about sudden drops. The analysis highlights online comments calling it a scam. It shows this weird brand tension. Institutions trusted implicitly, but many individuals being scored feel resentful, maybe.
Interesting. And the B2B customers? The banks using the software?
It's more like respect, but with some grumbling. The analysis mentions Gartner reviews, generally positive, around 4.2 stars.
So they value the software?
Yeah, they see the products as powerful, flexible, effective for managing risk. But criticisms pop up, steep learning curve. Sometimes the interface is slow for complex stuff. Setup and integration can be challenging, so it's like mission critical, effective, but maybe not elegant or easy. Tolerated for its power, perhaps.
Okay. What about inside the company? The employees? Solid culture. Any red flags?
The analysis suggests it's solid. Maybe not exceptional, but okay. No huge red flags, but maybe not a super unique, inspiring mission either.
What are the positives mentioned?
Things like good managers, collaborative teams. The analysis quotes phrases like joint success, collaboration, empowering others. Positive internal scores, high percentage of positive reviews on sites like Comparably.
And the downsides? What do employees want improved?
Compensation comes up. Feeling undervalued, wanting better alignment with inflation. Also some comments about organizational structure, needing leadership to break down silos between departments. Gets a C+ rating overall on Comparably.
All right, let's talk leadership. Will Lansing, the CEO since 2012. How's his tenure described?
Long and stable. He was on the board even before becoming CDO. The analysis paints him as very long-term focused, very owner-oriented. Act like an owner is the philosophy mentioned.
Focused on results for shareholders.
Yeah, customer success, innovation, but definitely shareholder results. And the analysis says his actions back that up. He owns a ton of stock personally, over $500 million worth mentioned.
That certainly aligns incentives.
Definitely. And his strategy, as described, is disciplined. Focus on the core optimized scores pricing, transforms software to the platform, avoids big, risky acquisitions, seems rational.
And how do they handle all the cash the business throws off? Capital allocation.
This is highlighted as a real strength in the analysis. Exceptionally consistent, rational, shareholder-friendly.
Annie.
Well, they reinvest what's needed R&D for the platform and scores, necessary CapEx. They do small targeted acquisitions. But the main thing, returning cash to shareholders.
Through buybacks, not dividends, right?
Exactly. No dividends since 2017. It's all about aggressive share repurchases. The numbers and the analysis are pretty stark.
Give me some examples.
Okay. Fiscal 22, about $1.1 billion bought back at around $409 a share. Fiscal 23, $405 million at $659. Fiscal 24, about $828 million at an average of $1,366 per share.
Wow. Buying back huge amounts even as the price went way up.
Exactly. The analysis says management passes the rationality test with flying colors. By pouring cash into buybacks, they're signaling that buying their own stock is the best investment they see. It's seen as very owner-minded.
Okay, let's touch on the financials qualitatively. The analysis calls FICO an earnings machine.
It really does. The profitability is just stellar. Those scores margins near 90%. Consistent growth in revenue and profit over the last 5 years shown in the data. Pretty resilient, too.
And the key quality ratios. Return on invested capital, ROIC.
This really jumps out in the analysis. 56.3% in fiscal 24 and rising. That's incredibly high. Way better than peers. The analysis calls it maybe the single best sign of a great business, a strong moat, just a compounding machine.
And free cash flow conversion. Does the profit turn into actual cash?
Yeah, consistently over 100%. It was 118% in FY24. So they generated even more free cash flow than net income. Shows it's not capital intensive, the profits are real cash.
Balance sheet, okay.
Debt levels.
Described as prudent. Manageable leverage for such a stable cash flow business, net debt to EBITDA between 2x and 2.8x. Interest coverage is strong, over 7x. Looks safe. So financially, a picture of incredible strength, which brings us to the price. The market knows this is a good business, right? The valuation reflects that.
Oh, absolutely. The analysis calls the valuation demanding, very high multiples. Trailing PE cited between like 67x and 87x. Price to free cash flow around 66x.
Much higher than the average stock and high even for FICO historically.
Exactly. The market is definitely pricing in that superiority. But the analysis flags this as a demanding entry point. Says there's little margin of safety at these levels.
Meaning if you invest now, you need a lot of confidence.
Extreme confidence is the term used. Confidence the moat holds up. Confidence they deliver the growth needed to justify that premium. The analysis suggests the current price fully bakes in future success and assumes the regulatory stuff works out okay. Great company, maybe not a bargain price.
So what are the growth drivers the analysis points to? What could justify that price?
It comes back to that dual strategy we talked about.
More price hikes on scores.
That's explicitly mentioned, yeah. The analysis suggests there's still room to optimize pricing, especially since the score cost is tiny compared to, say, a mortgage. Also, getting newer scores like 10T adopted more widely beyond just mortgages, and international growth.
And the software platform, that's seen as a growth engine too.
Definitely. That's the big long-term play described, becoming the core decision engine for institutions. The growth in recurring revenue, that high net retention, that's seen as crucial. It's presented as both a growth driver and maybe a hedge if the scores business faces more pressure.
Okay, given the high price, the risks become super important. What does the analysis identify as the big long-term threats? The things that could permanently damage the business?
Three main ones stand out. The biggest, most immediate one is called regulatory displacement.
That FHFA mandate again, VantageScore in mortgages.
Precisely. The analysis uses strong language, calls it an existential threat. The fear is, if VantageScore gets established in mortgages, it breaks FICO's monopoly, erodes the network effect, kills their pricing power.
And could spread.
That's the worry. If it works in mortgages, maybe it happens in auto loans, credit cards too, leading to a long-term slide in margins and profits. That's the nightmare scenario.
What's the second risk?
Technological obsolescence. Longer term. Banks getting better at building their own AI scoring models using all the data they have. If their internal models get better or cheaper than FICO,
They might rely less on FICO. It becomes a commodity.
that's the risk, yeah. Disintermediation.
And the third?
Antitrust action. Being so dominant, raising prices like they have, it attracts attention. The analysis mentions politicians calling for scrutiny. So there's always a risk of investigations, lawsuits.
Which could lead to forced changes, price caps, things like that.
Exactly. Things that could permanently hurt the business model and those amazing profits.
So summing up the market view described in the analysis, it's respect mixed with anxiety.
That seems to be it. Cautious respect, recognizes the quality, the moat, the execution, but nervously eyeing that high valuation and especially the FHFA risk. The stock's volatility reflects that tension. Wonderful company, demanding price, facing its biggest storm that captures the consensus view presented.
The analysis also offered a contrarian take, right? An alternative way to look at it.
It did. It floated the idea that maybe the market is overplaying the speed of that moat erosion
Right.
and maybe underestimating a couple things. Institutional inertia and the value of the software platform.
Inertia, meaning things won't change as fast as feared.
Kind of. The analysis argues switching scoring systems in mortgages is a massive, slow, complex, expensive project for the whole industry. Decades of habits, systems built around FICO. It creates huge resistance.
The Lindy effect you mentioned.
Right. So lenders might pull both scores to comply, but still rely heavily on FICO internally for years. The erosion might be slow, contained, not a sudden collapse. That's the argument.
And underestimating the software platform.
Yeah, the idea is the market's so fixated on the scores risk, it's maybe missing how valuable the platform is becoming. That strong recurring revenue growth, the high net retention, it shows it's sticky, valuable, building its own moat.
A second engine almost.
Potentially, a
Right.
significant growth area, maybe a buffer if scores weaken, so the market sees a fortress under siege, but maybe misses the new Bastion FICO is building right next door. That's the contrarian angle explored.
Okay, so boiling it down, the investment thesis summary of the analysis. Bull case is the strong moat, great financials, smart management buying back stock, plus that software upside.
Those are the key points for the bulls, yes.
Bear case, the huge regulatory threat, the high valuation, long-term tech risk, and political scrutiny.
The main worries laid out clearly.
And finally, that red team challenge, trying to poke holes in the bull case. What's the story there?
It basically asks, what if the moat isn't strong enough this time? What if the FHFA mandate is the tipping point?
How would that play out?
Lenders are forced to use VantageScore. They find it's good enough. Suddenly, FICO isn't indispensable. The single standard is broken.
And that breaks the magic.
Right. It normalizes using alternatives. FICO's pricing power evaporates, margins shrink, the premium valuation collapses. The analysis suggests the stock could fall 50% or more and maybe never recover because that core network effect is gone, broken by the government.
So you thought you bought an invincible fortress.
But you actually bought a business with declining margins and a shrinking multiple. A value trap. That's the red team warning from the analysis.
Wow. Okay. So putting it all together from this analysis, FICO is painted as just a phenomenal business historically. Incredible financials, dominant position.
The quality metrics are undeniable based on what's presented here. ROIC, cash flow, top tier.
But it's priced for perfection, and it's facing this really significant new kind of threat, mainly from regulators.
That's the core tension, isn't it? Quality versus price and this evolving risk. It's all laid out in the analysis you shared.
It really is. Which leaves us, and you the listener, with a fascinating question to ponder, based purely on this material. Given the financials, the historical moat, that high price, and this regulatory storm, which force wins out in the long run? Is it the inertia protecting FICO? Is it the promise of that new software platform? Or are the external pressures just too strong this time?
It's definitely not simple. Requires weighing those different factors carefully based on the evidence in this analysis.
Absolutely. A lot to think about and certainly a situation to watch closely going forward.